Welcome to this week's sentiment analysis for the week of April 26th, 2026. We're going to start by looking at my live trading account because over the last week, quite a few things have happened, and at the same time, absolutely nothing has happened. As we look at the actual candlestick chart, this month's current candle looks to be pretty much in range with what we've seen over the last several months. In that regard, nothing has happened. There has been a little bit of volatility here and there, but nothing that has really moved the needle one way or the other. And that's actually very important, as we're going to see very shortly within the total view of what the market actually has looked like. So as we progress and we see the market as a whole, we see where the buyers and the sellers are for Euro USD. We get a clear picture because that's going to be fundamentally important. That is, the actual money within the Forex market, the currency pairs themselves, aren't showing much interest in really moving either up or down. We have a reasonably quiet equilibrium that isn't necessarily going to be something to write home about. We had a few possible situations that might have been interesting, but overall they haven't really moved the needle. That's the important part that we really need to keep perspective of in relation to what we can expect next week and coming in the future, or at least what might be a reasonable assertion of the market. So without further ado, let's get into some more charts. We're actually going to look at HESA charts, the human emotional sentiment analysis of news, and we're going to see the interesting patterns that this news has created. Now, from the standpoint of the chart we are looking at on the screen, this is strictly news items being evaluated as either fear or greed. Let's zoom in and get a better perspective of exactly what we are looking at. Now, if you've been following the support server, you'll know that I've started moving to 1 hour samplings, testing a theory. My theory was completely wrong. I expected to see more cyclic action than what is actually occurring, which is rather interesting because when you look at the charts over time, it suggests that a cyclic occurrence is happening. But when you really look at the actual entry point within each hour and the statistics behind it, it clearly shows that the theory of a cyclic news cycle isn't there. And that's really the key point of all this. So as we look at the chart, we can see that it is predominantly dominated by fear, large numbers of fear. That's important because the news media is pushing a narrative. That narrative is to advance the idea that you need to get out of the market, that you need to conserve your money, that you need to prepare for the worst. We see more commercials about buy gold, buy silver. Everything in the market media approach, whether it's the nightly news or commercials, are all pushing that you should get out of your stocks, get out of bonds, get out of trading or whatever investments you might have, because the market is horrible. It's important to keep this in mind because the next charts are going to actually be quite interesting. So we look at fear and then we look at the strength. The strength is quite telling. It's a very strong, heavy, negative push. The media is deliberately and intentionally pushing the narrative of fear, and it is doing so at a very aggressive rate within the market. That is 68% of all news that this system has actually evaluated is creating an atmosphere of fear. That's important. That's incredibly important. So let's really look at the context of the entire situation. So now that we've got the human side down, let's actually go to the Forex side, where I actually trade real money. Now we are looking at the Forex market, 7-day, and I have zoomed in to the part that we are talking about, the actual Forex currencies. The thing here is the standout. The market had a bit of fear in this area, but the strength is almost zero. Let's see, highest fear, not what I wanted, 56% fear, and 0.02% strength. Really? So the market, the actual currency market, had a 56% fear, 50 being the neutral point, with a strength of 0.02%. That is pretty much meaningless. Let's just put that on the table. From the standpoint of the market, that's basically somebody belched and hit the wrong button. Not even worth writing home about, not even admitting that it actually happened. But this is the currency market, the money that moves between countries. And yet we can clearly see it's nothing to worry about. But that's the whole point. When you look at the entire history of the Forex market, there have only been a few cases that we've had extremes of a 0.1%. 0.1% are the extreme cases. So that should tell you just how ridiculous some of the media narrative is compared to what countries are actually doing in their actual spending. GDP, CPI, all of the metrics necessary for a country to function. But now let's keep going. We're not done yet. Looking at the stock market, the indexes, institutions, banks, retirements, 401ks, all of the big numbers. Okay, we can clearly see here we have a moment of greed, and it has 68% greed on the scale and a earth-shattering roughly 0.5% strength. Really? 0.5% strength for greed. But again, when we look at the market oscillations, the strength, the highest and lowest actual stock market movement, real values from the indexes checked constantly, has only moved 1%. That's it. There's a lot of money in this market. People's 401ks depend upon this. Retirement accounts, institutional banks, hedge funds, all of that revolve around indexes like the Dow Jones, the Russell 3000, the S&P 500. All of that is in this. And yet, worst case, only 1% movement. Now let's put that in context. The context, when we look at the entire chart, is what we see here. We could actually see when these numbers take place. They're not that impressive at all. The stock market isn't showing what the news is showing. And if there should be a market that's going to react with fear, people wanting to protect their retirement accounts, is going to go through the roof in terms of actual fear. But yet, when we look at the market, when we really look at those numbers, we don't see that. But let's keep going. Let's look at the crypto market. You know, the crypto bros, the Wild West. They do all sorts of crazy stuff. And yet the worst case for them is 2%. That's it. 2%. So BTC had a bad day. Whoopee. It only affected the market 2%. Now that's significant in terms of the amount of money involved. But at the same time, it's not that significant. And that is actually the whole problem. It doesn't justify a media hype of 85% fear. Even when we look back historically, we see it's not the first time we've had 2% dips. But we clearly see most of the market is on the fearful side, but most of it is actually very minimal. A bad day for BTC, XRP underperformed, so forth. Basic things you would expect in a market. Let's see, for example here, 0.77% fear. That's out of 1,300 assets. 0.77% strength of negative asset. That isn't even 13 negative assets in the market. So you have a large amount of fear, but it's not supported by a rational context. But that's where we're at. That's what the media is actually trying to do in the market. They're not telling you what the news is. They're trying to create the news by manipulating you into believing something that is not real. Now I've got an analysis down below in the Patreon that goes through a lot of this data, basically using a new model, and I ran all of my research, all of my news articles, everything through this to actually find out and see what is going on. Take a few minutes after this video to read that content because it's quite interesting. It's very telling when you look at just what is really being presented in the market versus what actual financial institutions are doing. And we have a lot of opportunities right now. It does not mean be irresponsible in your investing, but it does mean that the market is clearly showing opportunities of greed. Greed as high as 80% in some areas. So a worst case scenario and an eye for the opportunity, and you're going to come out on top. Share your thoughts though. Let me know what you think of this information. But most importantly, as you trade carefully, trade responsibly, because that is going to be your best secret. It isn't about over-leveraging your account. It's about understanding why the media is pushing what they're pushing. And now finally, we're going to talk about what I've been building in terms of the Jackrabbit Technical Analysis Framework. So let's get into that. Okay, here we are, the final leg of this video, and part of what I've been talking about with my worst case scenario. This is a Bollinger Bands RSI Gann high-low momentum process. I started out trading, learning Bollinger Bands RSI, and I've taken everything over the years into building this whole process. Now this is using the Jackrabbit Relay Technical Analysis Library, and it's in the process of actually running 100 simulations. We're looking at roughly about 40 or 50 of them right here. Once this is finished, I'll put this up on Patreon, but I've already posted the source code into the Discord server, so be sure to check that out. You'll find those links also below. As we progress, and we look at what we see, we can see that we start this analysis in 2013 and end it in 2026. So, from the standpoint of this analysis, I am using 1 unit. 1 unit represents 1 BTC, so all of these numbers can be extrapolated to whatever you want for a price. Whether it is 0.1 BTC or 100 or whatever you can afford. The goal here is to demonstrate principle. So let's actually start tearing this apart. Maximum open positions at the end of the run, 13. Now this changes widely because I am using the 2-week candle chart to get the whole history of BTC, and then I'm building synthetic candles between the real candles. That is, I'm filling in and creating a Monte Carlo simulation of what each of these trades should be. So I can get a very clear estimate of what the strategy is going to do in its best case and its worst case. And so far, its best case is showing only 11 positions. Its worst case is 15 positions. So it's showing controlled descent. Now, much like my previous strategies, this is using the take profit and deviation based upon the highest high. Therefore, it guarantees even more risk mitigation built into the strategy itself. And that's the important part, especially when BTC hit its all-time high and then plummeted down 80%. So even in my worst case situation, if I had a $10 position size, I would have only have had $150 maximum exposure. That's incredible, considering that actually destroyed hundreds of millions of dollars in the market. So by using this kind of an approach with the all-time high as the discriminator versus the actual current price, the mitigation approach is phenomenal. Okay, so now as we progress and we look at average buys per trade cycle, we can see that for the most part, I'm going to say 3, because you can't have 2.5 buys. But you see 3 buys per trade cycle, pretty reasonable, pretty decent. That's it. Once in a while you might go higher, but again, the risk mitigation process keeps control over the entire situation, so your trading never gets out of control. That is critical. That is very critical. So now let's look at the buys. We can see we range from 120 to roughly 150 maximum purchases. This is an accumulation strategy. So it will accumulate based upon the deviation. But because the deviation is based upon the all-time high, it has a built-in risk approach automatically. So that the more the price drops, the more defensive it actually becomes. It guarantees against runaway accumulation. The sells, we can see we have roughly mid-50s to roughly mid-60s. Again, control. That's important. P&L. This is the important part. And because of the way I did my extrapolations, it's very easy to take what you see here, representation of 1 BTC, and then actually scale it to a representation of what you might actually use. For example, let's focus on this one right here, 179340. That's my P&L. So that's the number of dollars I've made throughout the 13-year life of this asset. So that's with 1 BTC as the base price. Now that's not practical for most people. Most people would use 0.01 BTC or similar, in which case you're looking at roughly $1,793. So you can see that a rough $10 or so position still has a huge and significant profit with this type of strategy. And if we look at the average P&L, again, same thing, $13.38. Well, the average would be $13. That's not bad. That's respectable for the trading process we are using. Okay, so now let's move to the next section. The number of purchases per day. 39 days. Purchases per day is average of 39. Tongue-tied there and ahead of myself. Profit per day. Jeez. So this shows $39 for profit of 1 BTC. So if we have 0.01 BTC, our profit per day is going to be 39 cents. Clean, simple, and provided I don't get tongue-tied, easy to understand. Now we look at days in between purchases. So what this tells us is that we waited roughly 35 days for every single purchase. This is not a fast strategy. It's a consistent strategy that weathers out market fluctuation and volatility. That's the important part to understand. You are getting rid of risk by actually focusing on a wider, more broader spectrum. So now we have days between sells. And this is important because we did one sell every 85 days, but we did one purchase every 39 days. So you have a very clear and concise approach. Or every 35 days. We look at the wrong number. So we made a purchase every 35 days. We made a sale every 85 days. You see the dynamics. You see how the accumulations took place. Simple. And the total duration, of course, is 4,603 days. So we have within the framework a clear, concise risk mitigation, a clear, concise layer of being able to determine best case, worst case, average case of the number of days between purchases, the number of days between sales, the amount of profit per day, and of course our average profit per day, along with the total profit of the entire run of the strategy should you have kept it running for the entire 13 years. This is literally everything I've talked about for years. Planning for the worst, but hoping for the best, and having a way to absolutely control exactly when that is going to be. 15 worst case positions is important. And once this is done of the entire trade, you'll be able to count the worst case, get an estimate on the percentage the worst case happened within the 100 test cycles. So that can give you an average expectation of when a worst case process will happen on the basis of actual real world history. Remember, this source code for this strategy is in the support server, and it will be on Patreon once this analysis is complete. Let me know what you think. Share your thoughts. Ask questions. Thank you for watching.